Good morning, everyone. I'm Vince Lancy. This is the Gold Fix Market Rundown. It's 7:43. We have two things to discuss today. The first one is big picture. Goldman says that central banks will be buying gold for at least 3 years. We'll get into that. The second one is almost tactical. Zero hedge notes, not too many people think a 50 basis point cut is on the table. And we'll get into some of the logic behind that. Well, we think the conclusion from that, if you're looking for a takeaway, tactically is the market's not pricing in a 50 basis point cut, which might be proper, but the potential for it might be a lot bigger than they're handicapping. The mainstream may be behind the curve, possibly. Here's the home page. Let's start with the markets. 10-year yields are unchanged, 404. The dollar is 96.99, down 35. The S&P 500 is up 14 and change. The VIX is down 15 basis points. Gold, 36.95, up 17. Relentless U.S. buying. Normies. Silver, 42.80, up 11. Creeping, threatening, 43. Copper, 463, down a penny. WTI 63.86, up 42. It's really something going on there. Natural gas 305, up 4. Bitcoin 115 and change, down a little bit. Ethereum 4,500, down 22. Palladium up 11. Platinum up 4. That spread is $200 now. Platinum over. Gold silver 86. That stability is very good. Grains all up uniformly. So someone got a buy order. 1031, 419, 532, up 6, up 3, up 3. 60 basis points each. There's the home page. We will be talking about the lower left-hand corner, Goldman Central Banks buying gold for years. That went out this morning based on a report that Goldman Sachs released, I think, on the 12th. And the other story isn't on the screen. It's a couple days old, but we'll throw the link in there as well. We'd also like to draw your attention to The Work of Gold, Part 2. Oliver Bateman, we have become friends over the last, I'd say, 5 years, lurking in each other's feeds. And he's an excellent writer, and I've learned a lot from him. And he makes it look good. He makes what you say look smart. And of course, he's a wrestling fan. So that's why I was attracted to him as a writer initially. Anyway, so there it is. Let's start. Goldman, central banks will be buying gold for years. Now, last week's special voice note that we put out stated the real money is buying. We just said that. It just made sense. Well, that's actually confirmed by Goldman Sachs. Their chosen words in describing the new buying was literally real money in a separate note from what we're talking about right here. We say timetables are speeding up for something. We don't know. Maybe it's an HQLA repo rollout, which we wrote a paper on. Maybe it's nothing. But central banks are buying at current prices, and macro discretionary is kind of running the price up in their face. The gold is pushed above its multi-month consolidation range of 3,200 to 3,450, Goldman notes, gaining over 6% since August 26 to reach about 3,650, 3,695 as we speak. According to Goldman analysts Lena Thomas and Dan Struyven, the breakout reflects the influence of three key buyer groups. We list those key buyer groups in the post itself. Full analysis is in the premium post. Central banks will be buying gold for years. Just to throw a little something in there. In their analysis, they used China as the point of the spear, so to speak, in gold buying. And they say 20% is the level that banks need to get to at least. And they use China because China has 8%. Now, we all know China has more than that, way more than that. But the official reserves official has a purpose, and the official reserves, when they're stated officially, that's money that has to be pledged for whatever you're doing trade wise. And so they're showing 8%, and that needs to get up to at least 20%. We add our 2 cents saying that, several months ago, Bank of America released a report saying that 30% was optimal efficiency, kind of efficient frontier concept. And we wrote that up. And we say that Goldman is just being conservative and using China as their anchor. When China gets to 20%, we think they'll say 30%. And if you need proof of that, Poland just upped their allocation from 20 to 25 to 30% in a series of months. And as Eastern Europe goes, so goes the rest of the continent over there, we think anyway. Anyway, that's the story, and you can find it in central banks will be buying gold for years. The second one is, let me pull this picture up first. Where is that? There it is. This one. Let's make it a little bigger. All right, so they put a post. Zero Hedge put an X post out yesterday or today. I'm not sure when. Um, they put out a post showing the market reaction grid that JP Morgan thinks will happen during the FOMC. So if the market goes, if the Fed cuts 50 basis points, I think the market will do this, market will do that. But they put an insight, and the insight reads like this. Two things stand out to them. The first is a 1% chance of a rate hike. This would confirm the Fed was never actually independent, but is driven by whoever occupies the White House. It's hard to tell sometimes if they're being sarcastic or genuine, but 1% chance of a rate hike, that's kind of insane. Anyway, and only a 7.5%. This is what we're going to focus on, though. 7.5% chance of a 50 basis point rate cut. Market could drop 1.5% or rise 1.5%. Now, forget the second part of that. Based on things that I've seen and other things that they've kind of hinted at in their premium posts, most of the mainstream economists, and by mainstream I mean everyone, Bloomberg, all the publicly facing banks, everyone is saying 25 basis points. Everyone. We are in a bubble, and our bubble is we want gold to go up. So we say 50 basis points. So we say the Fed's going to ease more. We say the Fed is stupid. And, most of the time I would throw water on that. And I'd say, be careful, the mainstream is in control, and we're probably getting a little bit euphoric. But that's not the case now. And let me get to that point right now. We published a post based on an analysis by Standard Charter. Hat tip to you know who. And Standard Charter correctly handicapped the revision in jobs. Remember the revisions were dropped down by 900,000? They explained in a post or two or a report or two why they felt that would happen. Now, but they did that after Zero Hedge actually handicapped the concept, and Goldman did as well. But they did it in a way that was very understandable. And so we wrote it up. We thought it was very educational as well as actionable. So let me just read what they said, and I'll bring it back to the why I think the mainstream media might really be low on this 7.5% chance of a rate cut. Standard Charter said not many people think a 50 basis point cut is on the table. They think, markets and policymakers are misreading published labor data. A 50 basis point cut should already be under serious discussion. Now, they think it is almost a no-brainer we should get a 50 basis point cut. And they go through the reasons for it, and hopefully we've translated it so it's not too over our own heads, right? The first one they say is the work dropout rate is growing. They think unemployment is higher than it looks. the work dropout rate is growing. So there are more people staying unemployed permanently, choosing to not be in the workforce. The second one, and this is the one that goes back to something that Zero Hedge noted, was that before the revisions last week, well, they and a couple others, ZH and what have you, were saying the revisions will probably be bad again because this system, the way they calculate this birth death equation, has a legacy and it's slow to roll over. It's pro-cyclical. And as a result of that, they said the revisions will be bad again, will be low again. And they were, 500,000 to a million. And it turns out to be at the upper end of that, 911,000. Standard Charter goes further and they just throw it in there, but they say, the revisions out to at least March of this year will also be lower. They believe that the jobs creation between January of this year and March of this year will also be revised lower. And so they think that if you don't think we're in a recession right now, you might be wrong. That said, coming back to the main point, 7.5% chance of a 50 basis point rate cut is low. And that's what everyone in the media, the regular media, is telling you. And that's because they're in a bubble too. They're in a bubble, and their bubble is very neo-Keynesian. And it says this, it says that, they're looking at whatever they're looking at. And we're looking at whatever we're looking at. And I love to throw water and say, be careful. But today, I'm saying I think that a 50 basis point cut is much higher than a 7.5% chance. And I think it based on this analysis influencing me. And I would suggest if you're looking for something to wrap your head around how these things interact between policy and perception, this is a good piece to read. If you're just looking for insight in terms of the market tomorrow, well, if I'm handicapping all this properly, then the markets are under handicapping a 50 basis point cut, which means if we get one, I don't think there'll be a pullback at all. I've been talking about pullbacks being an eventuality. I don't think there'll be a pullback at all. It's almost like 25 basis points is cutting. So imagine what gold does if we have a 50 basis point cut. I don't know. Maybe the trade is to not be long gold going into it, to just be short the dollar because gold's run up and the dollar's been pretty orderly with its drop. Anyway, that said, I'm starting to feel very strongly that the media is wrong on this. The media is missing the jobs thing. They keep saying, oh, it's just a one-time revision. And that's because they're defending Biden. That's because they're defending that administration. But watch, when the jobs are knocked, just correlate, when the jobs are knocked down again in January through March, they'll be all over that, because they're biased against Trump. Anyway, that full analysis is in the Premium Post. Bank, Standard Charter, how BLS jobs data is cooked. We also have the link to that Zero Hedge post on topic here. Related post, Goldfix PM, it's good to be the king. Could be famous last words, but you get how it works. Dollar debates and gold's winning endgame. That's an Egon von Greyer's piece. What is the BRICS real goal with gold? That was where we laid out what we think is really going on here. You're not just buying gold to be a pet rock store of value if you're a BRICS country. You're buying gold to leverage it in financing and grow your economies. At least that's what the junior BRICS want to do. Jim Rickards' Fed independence has never really existed. Great polemic. And a top secret founder special. In case you missed it, we're looking through some older posts to see how right or wrong we were. And we found one from April of 23. Why are central banks really buying gold? And that was completely an opinion piece. And in that piece, we made a statement. And the statement was, this was about the Ukraine war. We were talking about the Ukraine a lot more. And we said, people at the time were pushing back saying gold's going up, gold's the problem. Gold's going up, gold's the problem. Look, the world's not, some macro analysts are saying, well, gold is the problem. We need to get along better. And I was saying, gold's not the problem. Gold's the symptom of your problem. Anyway, gold didn't invade the Ukraine. Gold didn't freeze Russia's assets. Gold is telling you none of that should have happened. That's it. It's a good piece, if I say so myself. Uh, in the chat, we have a new chat started there. Um, Lots going on, all kinds of contributions from people, as well as ideas, and they're giving me questions that I can answer on here. It's fabulous. Thank you. Let's hope that it gets going when we wake up and gold's $1,000 lower. Not going away, that won't happen. Uh, Today is the first day of the meeting, but it's 8:30 U.S. retail sales. Wednesday, tomorrow, 2 p.m. is the interest rate decision. It's very important tactically. I think it's completely unimportant strategically, and the big money probably agrees with me. Thursday, initial jobless claims, and Friday, Mary Daly is speaking. Moving on to, there we go, charts and final market check. I want to just mention Econ Circus, we're mutuals on X, and he threw a VIX chart up there, and it caught my eye. To the extent that gold and the VIX are correlated, gold is leading the VIX a lot now. I'm not 100% sure of that, but he noted that the VIX might be a little bit too oversold here. And I'm going to give you a level to look at. So if my level hits, his idea is potentially very right. Gold is in week 3 of the breakout system. Just keep that in mind. And silver is the perfect setup right now. The gold silver ratio is sub 89. Silver should rock very much if a 50 basis point cut as normies pile in. Remember, CTAs are all long gold for a recession. They're not long silver. They will sell their gold and buy silver, and it won't do anything to gold, but it will drive silver a lot higher. Okay, let's actually look at those charts. There's the gold daily. All right, let me go to the Bollinger Band one to show you what I'm talking about. All right, so the VIX is at, let me see if I'm right here. Yeah. Wow. Okay, so yeah, the VIX has been trading at these levels long enough so that if it does get moving, you should not fade the direction. We are at a point where a rally should be getting more buying. And maybe it's related to the stock market. It's going to crap out. Who knows? But for me, uh, to anyone who's listening to that, if the VIX gets above 1644 on a daily close, we should be looking at an extended upside. So then you can start looking for targets like 22 after you get through 19 and change. So that's my VIX comment, but it is oversold. And if Econ Circus is right, this is my catalyst to pay more attention. Almost like if VIX gets over 1644 and I'm long a lot of gold, sell a little bit of gold, buy some VIX. Who knows? It's just a trade. It's not a religion. All right, next. Oh, we'll come back to this. Yeah. Gold on a weekly, right? The monster. We talked about the monster. That's the daily. There's the monster. Out and in. Out and in. Out and in. Out and in. Big, big in months, big out. Okay. Big breath. So it works 3 to 5 bars. We're in our 3rd week right now. We're well over the risk reward of the whole trade to begin with. So if you don't want to take profits and you want to be a pig because you think we're going to 4,000, I'm not going to stop you. But if you have money in this trade that you need in the next 90 days, maybe you're putting in a pool next summer, maybe you're putting your kids through school, then you need to think about where your stop loss is. That's all I'm saying. What if Powell doesn't cut at all? and we drop $500. I would gladly be able, I would gladly love to buy $500 lower. But suppose you need that money. I'm just saying. Remember that speculative money is speculative. I'm Vince. Have a great day.